On the surface, what is happening in Japanese currency markets appears to be a technical matter of exchange rates and monetary policy. Central bank officials have issued warnings, markets have moved, financial commentators have offered explanations. Most observers treat this as a routine episode in the long history of currency management. This assessment is incorrect. What is occurring right now involves a mechanism that has preceded every major financial crisis of the past century. This mechanism is active. The outcome is uncertain. The speed at which consequences unfold remains unpredictable. Begin with what is factually observable. On January 14, 2026, the Japanese yen depreciated to 159.45 per US dollar. This represents the lowest level in 18 months. The yen has weakened 2.01% in the past month and 4.8% since October 2025. On January 14th and 15, officials of the Japanese government and central bank released statements indicating their readiness to intervene in currency markets. Finance Minister Satsuki Katayama stated the government will not rule out any means and will respond appropriately to moves that are excessive, including those that are speculative. Chief currency official Atsushi Mimura warned Japan will take an appropriate response without disclosing all strategies. These statements marked the strongest intervention warnings released by Japanese officials in months. Simultaneously, Prime Minister Sane Takaichi announced plans to dissolve the lower house of parliament and call a snap general election, scheduled for February 8th. 2026. The election is designed to advance Takaichi's fiscal expansion program worth approximately $137 billion. The yen's depreciation began accelerating in earnest following Takaichi's ascension to the premiership in October 2025. The currency has declined steadily since then. The Bank of Japan has raised its policy rate to 0.75%, the highest level in 30 years. This rate increase represents an effort to defend the yen through monetary tightening. Yet simultaneously, the government has announced aggressive fiscal expansion. The central bank is attempting monetary contraction while the political authority is pursuing fiscal stimulus. These policies are in direct contradiction. The number 160 holds specific significance in this context. At this exchange rate level, the Japanese government and central bank have a documented history of intervention. The last major intervention occurred in July 2024, when the yen approached 161.96 per dollar. At that time, Japan deployed approximately $36.8 billion in foreign exchange reserves to purchase yen and defend its currency. The yen is now approaching that same threshold. Officials have escalated their warnings, yet they have not yet intervened. This gap between warning and action is the mechanism that matters. To understand what this mechanism implies, it is necessary to examine historical precedent. The pattern of currency defense under fiscal and monetary pressure has repeated across multiple nations and multiple decades. Each occurrence has followed an identical sequence. Each has ended the same way. In September 1992, the British government faced a similar situation. Sterling had entered the exchange rate mechanism, a fixed exchange arrangement with other European currencies. Sterling was required to maintain a peg within a band of plus or minus 2.25% of a central rate relative to the Deutsche Mark. Market pressures mounted against sterling. Speculators began shorting the currency. The Bank of England responded by raising interest rates on September 16, 1992. The rates were increased twice on that single day, from 10% to 12%, then to 15%. The bank deployed foreign exchange reserves to purchase sterling in the market and defend the peg. Despite these efforts, the defense failed within hours. Sterling depreciated approximately 10% against the mark following the government's withdrawal from the mechanism. Speculators who had positioned against sterling profited approximately $1 billion collectively. In May 1997, Thailand faced pressure on the Thai baht. The Thai currency was pegged to the US dollar. Speculators attacked the peg beginning in early May. The Bank of Thailand responded by raising interest rates to levels exceeding 50% per annum by mid-June 1997. The bank deployed approximately $24 billion, representing two-thirds of Thailand's total foreign exchange reserves, in an attempt to defend the currency. The defense persisted for 6 weeks. On July 2, 1997, the Bank of Thailand announced it would float the baht. By October 24, 1997, the baht had depreciated 60% against the US dollar. Foreign exchange reserves fell from $37.2 billion in December 1996 to $2.85 billion by July 1997. The currency crisis spread to Indonesia, Malaysia, and the Philippines. This episode triggered the Asian financial crisis, which lasted 18 months and affected global markets. In December 1994, Mexico faced a currency crisis. The Mexican central bank had attempted to defend a pegged exchange rate while the government ran large fiscal deficits. The central bank announced a devaluation on December 20th, 1994. Interest rates were raised to 25% and higher. But the government had converted half of its short-term debt from peso-denominated instruments to dollar-denominated instruments in the months prior. The central bank's foreign exchange reserves were depleted defending the currency. Within weeks, the peso collapsed from near parity with the dollar to 515 pesos per dollar. The Mexican stock market lost 50% of its value. The episode spread to Brazil, Argentina, and the rest of Latin America in what became known as the tequila crisis. A $50 billion IMF bailout was required. In August 1971, President Richard Nixon unilaterally suspended the convertibility of the U.S. dollar to gold. This action ended the Bretton Woods system. The decision was made in response to deteriorating U.S. balance of payments, rising public debt, and depletion of U.S. gold reserves. The gold reserve coverage had fallen from 55% to 22% by 1970. The action was taken without consultation with allied governments. Following the announcement, the dollar subsequently depreciated approximately 40% against major currencies over the following years. The floating exchange rate regime replaced the fixed system by 1973. These cases span decades and continents. Yet they describe the same mechanism. A currency is under pressure. A central bank or government attempts to defend it through intervention or rate increases. The defense fails. Speculators profit. Wealth transfers occur. Systemic consequences ripple outward. The mechanism operates as follows. When a currency is perceived as overvalued or unsustainable at current levels, speculators borrow the currency, convert it to other assets, and wait for depreciation. If the depreciation occurs, they repurchase the currency at a lower price, repay the loan, and pocket the difference. This transaction is called a short sale. In the case of yen carry trades, the mechanism is slightly different but functionally identical. Speculators borrow yen at low interest rates, convert the yen to higher yielding assets such as U.S. Treasury bonds, emerging market equities, or high yield corporate bonds. They profit both from the interest rate differential and from the yen depreciation. The estimated volume of yen-funded carry trade is approximately $1 trillion globally. The leverage embedded in these positions ranges from 5 times to 20 times capital. This means that a 5% yen appreciation would eliminate $50 to $100 billion in carry trade profits, and trigger margin calls, forcing liquidation of the underlying assets. What makes the current situation abnormal is not merely the yen's approach to the 160 level. It is the set of conditions that have enabled carry trade volume to expand to $1 trillion, while the underlying policy contradiction has intensified. The Bank of Japan has raised rates to 0.75%, while the government announces fiscal expansion. The government's budget deficit is already among the largest in the developed world relative to GDP. Japan's total government debt exceeds 260% of annual GDP, the highest ratio among major economies. Adding $137 billion in stimulus spending while the central bank attempts monetary tightening sends conflicting signals about fiscal sustainability. Markets interpret this contradiction as indicative of loss of control. The wealth transfer dynamics of such a crisis operate through multiple channels simultaneously. If the Bank of Japan intervenes to defend the yen by purchasing yen with foreign exchange reserves, it directly depletes the reserve asset base. Japan currently holds approximately $1.37 trillion in foreign reserves. An intervention of the scale required to defend at the 160 level could require $36 to $50 billion, similar in magnitude to the July 2024 intervention. This depletion is immediate and quantifiable. However, if the intervention fails and the yen continues to depreciate, the BOJ must repurchase dollars at unfavorable valuations, crystallizing losses on the timing of the intervention. But the more significant wealth transfer operates through a different channel. The Government Pension Investment Fund, Japan's largest pension fund managing 260 trillion yen, approximately $1.77 trillion, holds 24% of assets in foreign equities and 24% in foreign bonds. The fund lost $61.1 billion in Q1 FY 2025 from depreciating dollar holdings. As the yen continues to weaken, the yen value of these foreign assets declines further. Cumulative 2025 losses from currency depreciation alone are estimated to exceed $100 billion. Japan's aging population, with more than 15 million pensioners, is the ultimate holder of these assets. The yen depreciation directly erodes purchasing power of fixed pension payments. Japanese banks holding $500 billion or more in foreign securities experience mark-to-market losses as the yen weakens. If the BOJ is forced to raise rates further to support the yen, net interest margins compress as deposit rate competition intensifies. Small to medium-cap Japanese firms with unhedged foreign currency liabilities face rising debt service costs. Japanese exporters initially benefit from yen weakness, making their products cheaper internationally, but this benefit reverses if intervention forces yen appreciation. Leveraged carry trade participants face a different but more acute wealth transfer. If the yen appreciates 5 to 10% from forced intervention, leveraged positions experience losses equal to 5 to 10% of notional exposure. With leverage at 10 times, a 5% yen move represents 50% loss on capital. Margin calls forced liquidation of underlying assets. This forced liquidation creates simultaneous selling pressure across multiple asset classes. Emerging market bonds, equities, and currencies face capital outflows as carry trade participants liquidate positions to raise yen for loan repayment. The credit market seizes as high-yield spreads widen 100 to 200 basis points. Global equity markets face correction as deleveraging cascades. Historical precedent from August 2024 provides specific data. A smaller yen unwind in August 2024 caused the Nikkei 225 to decline 12% and the S&P 500 to decline 3% within days. A major carry trade, unwinding of the scale threatened by current conditions, could produce global equity market declines of 5 to 12%, representing $300 billion to $1 trillion in wealth destruction. But the wealth is not destroyed uniformly, it is transferred. Who gains in this scenario? Currency speculators positioned long dollars and short yen profit from continued yen weakness before intervention, and from carry trade, unwind volatility. Hedge funds with macro FX desks positioned for yen volatility generate profits. The US dollar and US Treasury market benefit as capital flees yen weakness and flows into safe haven dollar assets. Foreign currency reserve holders outside Japan, whose reserves are diversified away from yen benefit as their non-yen holdings appreciate in relative terms. Foreign investors purchasing Japanese real estate, equities, and businesses at crisis-depressed valuations acquire assets at discounts, positioning for gains when yen stabilizes. Gold holders benefit as carry trade unwinding drives safe haven demand for precious metals. The U.S. Federal Reserve benefits from relative dollar strength, which provides additional monetary policy flexibility and reduces inflation pressure from currency depreciation. The central mechanism of wealth transfer in such episodes is that the losses are concentrated among institutions that cannot easily exit positions, while gains accrue to those who anticipated the move and positioned accordingly. Japanese savers accumulating losses in pension funds cannot instantly reposition. Banks with large foreign asset portfolios cannot liquidate without triggering market impact. But speculators who shorted yen or positioned long dollars exit profitably. Those who recognized fiscal unsustainability and positioned accordingly gain. This concentration of losses and gains is not incidental to the crisis. It is fundamental to understanding why such episodes recur despite historical precedent. Behavioral economics and cognitive psychology reveal why institutions systematically fail to prevent or adequately prepare for such crises despite clear historical precedent. The dominant brain glitches operating in the current situation are well documented and repeat with surprising regularity. Normalcy bias is the first mechanism. After an extended period of stability, probability of large disruptive events is unconsciously treated as approaching zero. Japan maintained relatively stable yen levels from 2015 through 2024. This 9-year period of stability created psychological anchoring to the assumption that volatility is abnormal and intervention is improbable. When the yen approaches 160, institutions interpret it as temporary deviation rather than signal of regime change. Risk officers at banks underestimate probability that their carry trade positions will be forced liquidated because carry trades have been profitable for years. Disaster myopia describes the second mechanism. After years without major intervention or currency crisis, the subjective probability of such events is recalibrated downward. Academic research documents that banks systematically underestimate tail risk during periods of stability. The probability of major yen intervention is treated as near zero because the last significant intervention was July 2024, and before that, 1998. The 15 to 26-year gaps between major events create subjective expectation that next event is distant. Institutions underinvest in information about carry trade, unwind scenarios because the probability seems remote. Overconfidence bias affects both central bank officials and carry trade participants. Bank of Japan policymakers overestimate their ability to manage the yen through verbal warnings without actual intervention. The assumption is that markets will read the official statements and adjust positions accordingly, making actual intervention unnecessary. Previous successful communications by the Federal Reserve during the 2022 to 2023 inflation episode create confidence that verbal guidance can control market behavior. But currency markets operate differently than inflation expectations. Carry traders overestimate their ability to exit leveraged positions quickly and cheaply during stress. The experience of profitable exits during normal market conditions creates confidence that similar exits will be available during crisis. This assumption is false. During forced unwinding, all market participants attempt to exit simultaneously. Bid-ask spreads widen. Liquidity disappears. Exits that were possible at favorable prices during normal conditions become impossible at any price during crisis. Authority bias causes investors and policymakers to assign excessive weight to official statements and the views of those in positions of power. Market participants defer to the Bank of Japan as statements because the institution holds authority over monetary policy and reserves. They assume that if BOJ officials are calm, the situation is manageable. They fail to recognize that central bank officials operate under political pressure and may be optimistic in public while privately concerned. Prime Minister Takaichi's authority as elected executive increases credibility of her fiscal expansion announcement. Despite the economic contradiction it implies, investors assume the government must have a backup plan, or that political authority implies economic competence. Neither assumption is reliable. Groupthink within central bank policy committees suppresses dissent about intervention necessity. Monetary Policy Committee voting patterns, documented in academic research, show that chairman preferences almost universally prevail. External members dissent only slightly more frequently than internal members. Culture of consensus creates illusion of unanimity. Once the committee consensus forms around verbal guidance is sufficient, revisiting this consensus requires individual heroic dissent that carries career risk for the dissenter. The result is that institutions become trapped in policy approaches that market participants recognize as inadequate, but institutional cultures prevent policy revision until crisis forces change. Recency bias causes traders and institutional investors to assign excessive weight to recent profitable performance. The yen has weakened 2% in the past month and 4.8% since October. This recent weakness is profitable for carry traders. They extrapolate this trend forward and assume further weakness is probable. They discount the August 2024 episode when the yen briefly spiked before stabilizing, characterizing it as a minor event. The memory of crisis is weak compared to memory of recent profits. These cognitive biases are not individual failures. They are properties of human cognition and organizational behavior, but they repeat because structural incentives reinforce them. Career risk for policymakers creates incentive to delay difficult decisions. A central bank chairman can gradually lose credibility through ineffective policy without triggering immediate crisis, but a visible intervention failure immediately damages reputation. This asymmetry creates incentive to pursue gradual approaches that might fail silently rather than decisive approaches that might fail publicly. Central bank officials can claim that verbal guidance is being implemented even as carry trade volumes expand. They avoid the decisive test of actual intervention until forced by market crisis. Political pressure on central banks has intensified in recent years. Prime ministers and presidents have openly criticized central bank policies. This creates pressure on central banks to avoid public positions that conflict with political preferences. The BOJ faces implicit pressure not to discuss fiscal sustainability because such discussion might undermine political support for the government. Officials self-censor to avoid controversy. This suppression of honest risk assessment reinforces optimistic groupthink. Regulatory arbitrage and inadequate monitoring create conditions where leverage accumulates in the financial system without full visibility. Carry trade leverage is distributed across multiple institutions, jurisdictions, and instruments. The Bank of Japan and Ministry of Finance do not have real-time data on total yen-funded carry trade exposure globally. Leverage in the shadow banking system, securities lending chains, and derivatives markets is not fully transparent until forced unwinding occurs. Regulators cannot target a risk they cannot see. Competitive pressure among financial institutions creates prisoner's dilemma dynamics. If one bank or hedge fund reduces carry trade exposure, it sacrifices profitability relative to competitors. Peer pressure reinforces herd behavior. Institutional pressure to maintain positioning suppresses individual institutions' incentive to exit. Finally, each carry trade unwind episode is partially forgotten due to long time gaps, new generations of traders with no memory of previous episodes, and narrative framing that emphasizes the uniqueness of each event. The 1997 Asian crisis, the 2013 taper tantrum, and the August 2024 yen flash crash are treated as distinct episodes with different causes rather than recurrences of the same underlying mechanism. This narrative control creates psychological distance between historical event and current situation. The systemic implications if the pattern continues are substantial. A major yen carry trade unwinding would trigger simultaneous forced liquidations across multiple asset classes. Emerging market currencies would face capital outflows as carry traders sell EM bonds and equities to raise yen. Central banks in emerging markets would be forced to defend currencies, draining foreign exchange reserves and forcing interest rate increases that would slow economic growth. Global credit spreads would widen as high-yield bonds face forced selling. Global equity markets would decline as deleveraging cascades. Banking system stress would manifest through widened repo spreads, increased funding costs, and potential deposit flight from institutions with large foreign asset exposures. The Japanese government would face pressure to implement capital controls or asset seizures to prevent reserve depletion. The yen might be allowed to depreciate sharply, triggering domestic inflation and real income decline for Japanese savers. Political instability could intensify if voters blame government and central bank for policy contradictions that produced the crisis. International coordination would be tested as central banks attempt to manage coordinated carry trade, unwinding and stabilize currency markets. The International Monetary Fund might need to provide rescue financing to emerging market nations facing currency crises triggered by carry trade unwind contagion. The current situation has reached a specific inflection point. The Bank of Japan has escalated verbal warnings. The yen approaches the 160 intervention threshold. Prime Minister Takaichi has called snap elections tied to fiscal stimulus. The central bank has raised rates to the highest level in 30 years, while the government announces budget expansion. These conditions have preceded currency crises throughout modern financial history. What distinguishes the current episode from routine currency fluctuations is the policy contradiction, the scale of carry trade leverage, and the proximity to the intervention threshold, combined with uncertainty about official willingness to intervene. Markets are testing whether Japanese officials will back verbal warnings with action. The outcome of this test is uncertain, but uncertainty in itself is the defining feature of crisis conditions. The mechanism has been activated. The speed at which consequences unfold will depend on whether intervention occurs and whether it succeeds in stabilizing the yen. If intervention fails, or if the market loses confidence in official commitment to defend, carry trade unwinding will accelerate, triggering the forced liquidations and wealth transfers documented in historical precedent. The Japanese situation is not isolated. Global carry trade leverage, interconnected financial institutions, and real-time capital flows mean that a Japanese yen crisis would rapidly transmit to emerging markets, credit markets, and equity markets globally. The pattern of crisis that has repeated since at least 1992 continues to operate. The conditions activating the pattern are currently in place. What occurs in Japanese currency markets in the coming weeks will determine whether this becomes another data point confirming the historical pattern, or whether new institutional capacity prevents the mechanism from operating as it has previously operated. The evidence available suggests the mechanism remains substantially intact, and the conditions are actively triggering its operation.